A few members actually saw a case for raising rates at the June meeting itself. So there was a few members that actually thought we should have raised rates in the meeting that just happened. We have Fed meeting minutes and geopolitical tensions really driving the headlines here this week. So we will make sure to catch you up on everything that's gone on so far this week in trading after the short week for the holiday there just last Friday. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered each week and bring to you some of the data, the stories, the news that we're watching that are really shaping the markets. And again, this week there's really two primary stories that are kind of taking the headlines, so to speak. One is certainly the geopolitical tensions and what's going on in Iran, and the other is the Fed meeting minutes that came out just yesterday on Wednesday. So we'll just kind of take those one by one, break them apart a little bit. Keep in mind that we are back after a short week. So we did have the holiday last Friday. We are back now for a full week of trading again, and it kicked off with a bang. So Monday was relatively quiet. And then after markets closed, we had some news come out that that there was additional tension or tensions have picked back up, maybe is a better way to put it, in Iran after the close of markets. So what we saw as a reaction to that is two kind of tough days in the markets. So far on Thursday, we're seeing that that could be being put behind us for the moment anyways, but we saw that there was a strike on Iran, and as a result of that, we saw the markets kind of react negatively to that, and oil prices spike as a result of that as well. That was the main thing that's kind of driven markets so far this week, but yesterday on Wednesday, we also did receive the Fed meeting minutes from the first Fed meeting under Fed Chair Warsh, and basically there's some surprises, but nothing that's entirely new. What I will share is that a few members actually saw a case for raising rates at the June meeting itself. So there was a few members that actually thought we should have raised rates in the meeting that just happened, which was certainly not expected to see a raise in rates. Of course, that was not the result, but nonetheless, we did have a few members that saw the case for it. We also heard or saw within the minutes that they are considering the risk to inflation. Basically, what I think what they had shared is something along the lines of risk to inflation were tilted towards the upside. So in other words, they are not only concerned about the current inflation rate, but they're also concerned about the risk that inflation could continue higher. Along those lines, what they shared is that they shared inflation could stay high due to AI. I get the argument here, right? The idea is that, these big tech companies with their capital expenditures are buying, AI chips and all the above, and those prices aren't going to come down because there's so much demand and so little supply. Although that is a fair, assumption or something to consider, I think the bigger thing is money supply, as we talk about a lot. So I would point towards that as opposed to pointing towards AI being the story for inflation, especially given that, over time, and I don't expect this to happen tomorrow, but it could actually reduce potentially as a result. So anyway, that's something that they had covered in the minutes themselves. Whether that actually plays out the way they're suggesting and how it impacts inflation as a whole is a different story. So we'll continue to watch that. But clearly the Fed's paying attention to that, pointing towards that as maybe a reason we could see higher inflation, but whether it actually moves the needle or not, we will see. And keep in mind, when I say that, it doesn't mean prices for chips, for instance, may not stay higher or grow, but inflation as a whole is not just prices for chips. And so just keep that in mind. We'll continue to watch it, but inflation as a whole number is what I'm referring to when I say that maybe it will have an impact, maybe not so much. We could see a short blip as a result, but typically what happens is that money supply drives how much money is in the economy. And if there's only so much, if it goes towards the chips, it may come from somewhere else. The other thing that they had mentioned is the downside risks for maximum employment have moderated. So in other words, they're not too worried about the employment side of things necessarily at the moment. Again, this is still early on in the new Fed chair's reign, so we'll see how this translates over time, but that was something they had highlighted as well. All this is to point towards exactly what was covered when the Fed did share their decision, which is that although they didn't hike rates, it would look likely we could see higher rates, or at least they're looking at potentially higher rates as the year unfolds or into 2027. That said, there's a lot of time between now and then. So as the data unfolds, we will see what we get. But this is what they're watching. Basically, risks to inflation are high. Inflation is high, and then the downside risk to employment seems to moderate. So all that kind of speaks to potentially higher rates, or at least what they're looking at in the future as higher rates. But again, a lot of time, so we'll see how the data unfolds. Hopefully that helps. Be sure to tune in next Thursday. On Thursday we have, or sorry, excuse me, Tuesday we have CPI. So we do have some more inflation data coming out, very timely given the Fed meeting minutes. Wednesday we have PPI, producer price index data coming out. And then Thursday we have retail sales. So quite a bit to cover on the inflation and the consumer side of the economy next Thursday. In the meantime, have a great upcoming weekend, and we will see you next Thursday at 3.